This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Dianne Crocker here with my co-host Manus Clancy. Welcome to our 101st episode. And if you missed our 100th episode, we did an interview with LightBox CEO Eric Frank. If you missed it, take a listen. Eric covered a lot of ground on why he set out to modernize commercial real estate, his vision for connected data and streamlined workflows, and of course, his prediction that the Knicks would take home the trophy. How about that game last night, Manus? I don't think I have any fingernails left.
Thank you, Dianne. That was a great intro. Eric's interview last week was really terrific. It was 45 minutes really well spent. He articulated terrifically the intersection of all the things coming together that are going to be so life-changing for CRE professionals in the near future. But we have to start with that Knicks game last night. You teed it up perfectly, and I'm so glad we're going to dive into that before we get into this week's data and CRE news. You know, I'm still breathless from last night. I'm a casual Knicks fan, but I have completely jumped on the bandwagon at this point. I can't wait for all the games. I've been watching them with my youngest son, and it was complete white knuckle time last night. For those that are sports fans, you already know this. It was an instant classic. The Knicks came back from 29 points down to take the lead with 2 seconds to go and now hold a 3-1 lead in the series, a chance to wrap up their first title since the early 1970s on Saturday night in San Antonio. So New York is buzzing with excitement. I'm hearing from people that I haven't heard from in months. All of my kids have completely jumped on the bandwagon, and it's a great time in New York City.
It sure is. I was down there Monday night, not at the game, but a terrace party that Rockport hosted surrounding the CREFC conference. And it was just really cool to see the venues that were set up at the ground level and parks, just these big watch parties. And the city was definitely on fire, and I'm sure they went nuts last night. All right, Manus, we could talk about the game, for the full episode, but let's dive into the market news. Another week of headlines dominated by the war in Iran. It sounds like the strikes are set to resume again after weeks of diplomatic impasse. This week's inflation report shows that the CPI hit 4.2%. That is its highest level in 3 years in May. And that's on the heels of a jobs report that was stronger than expected, but uneven. Bond yields pushed higher, hovering around 4.55%. Equities had a rough ride. U.S. stocks sold off sharply, then tried to claw their way back. And I don't know, Manus, the market headlines have a real Groundhog Day feel to me this week. I can almost hear Bill Murray's alarm clock going off again and again. What do you think?
Well, I love the pop culture reference. Anytime you bring Bill Murray into the conversation, it's good for a chuckle, and that is a fun movie to watch. Let me break this into two parts, the geopolitical and then the data side of it. On the geopolitical, it feels like, here we go again. And your Groundhog's Day reference was spot on, that we're back to people being concerned about oil prices, that the war will continue. The ceasefire seems all but over at this point. The U.S. is now talking about taking some land on the island that touches the Strait of Hormuz. So here we go again. This is where we were in March. This is where we were in April. We had a pause during the ceasefire, and now we're back to kind of where we were at the beginning of the war. And we hope that at some point we get to the end of this, right? That we go back to life as it was in February. On the data side, there were 3 big headlines this week, and they painted a couple of different pictures. The first one, of course, the jobs report that you talked about on Friday. About twice as many jobs were created as were anticipated. Now, nobody thinks this is a blowout jobs economy. When the U.S. economy is growing, you like to see numbers of 250,000 per month, 300,000. This was below 200,000, but it was still better than expected. That contributed to that jump in bond yields that we saw on Friday, although I would say there were other contributors too, and we'll get to that later. I also think that the 2 inflation numbers we saw this week were concerning. So whereas the jobs report was helpful and positive, the inflation reports were not. Yesterday, we saw CPI 4.2%, as you noted. That was high, but it was in line with expectations. It was the oil jolt impact that we were expecting a month or two ago finally making its way through. This morning on Thursday, we saw the PPI number, which was even more alarming, month over month, up 1.1%. Which was considerably higher than expectations. So on the job side, good numbers. On the inflation side, very concerning numbers. So let me pause there, Dianne, and let me get your thoughts.
Yeah, I mean, I agree. We can't seem to get a consistent story across the board. And obviously, when you start talking about the jobs market and inflation, my mind naturally flows to interest rates because that is the dual mandate that the Fed faces, is to keep inflation down and the jobs market healthy. And now, of course, this month, I think it's next week, is the first Fed meeting under new Fed Chair Warsh. And I don't know if you saw this, Manus, but he introduced a term I'd not heard before, at least not recently, where he said in response to inflation that he prefers trimmed mean inflation measures. So any students out there, there's a new Econ 101 term, and it essentially means you strip out extreme price moves in order to get kind of a cleaner read on the underlying inflation. So his trimmed mean inflation measure runs much cooler than the dramatic headlines that we're seeing. And I bring that up because if Warsh persuades the committee to put more weight on this trimmed mean measure, then it means the Fed kind of has more room to hold steady and avoid overreacting to what's clearly an energy-driven shock on the pricing side. So I don't see that as a bad thing. So I'm interested in seeing, how he frames these latest inflation reports, whether he does it as a temporary geopolitical shock or as a broader problem that requires tighter policy. But I think, clearly over the near term, I think the rates will hold, at least for the June meeting.
Did he give any specifics as to what trim and lean means? I know we have alternative readings that strip out currently food and energy. Did he give any insights into where that was going, or was it just kind of a generic line that, we'd like to see new metrics?
Yeah, I think it was more of a generic comment that he's not going to run with the headline CPI numbers, but in terms of the impact of where that leads, the Dallas Fed's trimmed mean measure brings inflation down to 2.3%, and the Cleveland Fed's trimmed mean measure is at 2.9% for May. So that's kind of where it lands, but I'm not sure what they're trimming out specifically. I think the idea is to trim out the things that are really shooting it high, and obviously oil is a big part of that.
Yeah, maybe this will be too much editorializing, but he comes in with a reputation of wanting lower rates. He needs a justification for those lower rates, and changing the metric allows him to defend where he's going, right? You just can't say, I want lower rates without some kind of justification and be taken seriously. And it sounds like this is his marker, that we want to take away things like food and energy. But who needs those? Who needs food? Who needs energy, right?
Those are like our biggest necessities, right?
Right. But we saw the numbers today and yesterday, the CPI and the PPI. The core, which strips out food and energy, were still pretty benign. They were under 3% in each case. And to your point, this is an oil-driven shock to the system, nothing more. And of course, oil can push other things higher, like food and fertilizer and other things. But whatever uptick we're seeing right now is clearly oil-driven. So we'll see if his new message takes root with the other presidents out there, if he can make headway. But the numbers, the headline numbers, certainly are concerning to everybody.
Yeah, definitely. And that's why it kind of brought up the Groundhog Day reference, because it feels like the market keeps circling the same questions. When will the war end? How long will oil prices stay elevated? How patient can the Fed be? And how much the higher for longer pressures can borrowers, lenders, and investors absorb before the math behind deals change? So now we've got something that's changing the narrative a little bit, which is the new Fed chair coming in. So I'm curious to see what the commentary is after the June meeting.
When you talk about commentary, this is a segue of sorts, but I felt like after the jobs report came out last week, the national press, the financial press, gave us kind of a head fake and misled readers, I think, as to what we saw late last week and early this week. And I'd like your thoughts on this as well. We saw the hot jobs report. Bond yields jumped up right after that. And the markets, the equity markets, really collapsed. We really saw some of the biggest losses we've seen in the last couple of years, especially in the tech world. And the headlines we saw on Friday afternoon and Saturday was connecting the dots between jobs report, higher bond yields, and the sell-off. And I think that really missed what was happening last week and this week. On Thursday afternoon, after the bell, we saw really disappointing Broadcom earnings and commentary that they weren't bullish enough, and that got people very nervous. At the same time, late last week, we saw a couple of big tech operators say, we are going to raise more equity. We are going to dilute our equity to raise more money to invest in data centers and AI. And to me, I think that rattled people more than higher bond rates, because this may be eluding the casual market watcher that the big tech firms, until about 6 or 8 months ago, were just minting money quarter after quarter. Their free cash flow was through the roof, and the earnings and profit were real. What we've seen over the last 6 months is a lot of that profit has been erased. Now they're still producing profitable numbers because what they're spending is considered capital charges, which can be spread out over years and years. So it doesn't erode their earnings per se, but it crushes their free cash flow. So not only do these firms not have any free cash flow now, they're starting to use financial gimmickry to fund their data center purchases. And I think people are looking at this and saying, at what point is enough enough? And are we ever going to see a return on principle on this spend? Now, that's a real detour from the CRE space we really talk about, but I thought that there was more going on than met the eye last week and early this week.
Yeah, no, it's a good point. I mean, there were a lot of headlines this week about data centers, specifically about tech firms, about whether there's enough scrutiny around the math behind the assumptions about revenue growth and valuations. So it's almost like the honeymoon's over in that sector, and now everybody's scratching their head saying, wait a minute, are the revenue growth projections feasible? Have we really thought this through? Whether it's for AI infrastructure, for chips, for, cloud capacity, obviously data centers. But I mean, these revenue growth projections, I mean, we've all seen them. They are at a scale that I don't think we've ever seen in public market history. So it's maybe not surprising, and it's not a bad thing that the market's getting more discerning about the projects, the tenants signing leases, the locations, and which ones deserve premium pricing. What I'm also seeing starting to come into play more and more in the headlines is pushback against data centers. And we've touched on this a little bit in the podcast, but it seems like the tenor around NIMBYism, not in my backyard, as community level opposition to data center development is starting to gain more and more momentum. The Urban Land Institute had a really good article this week on that pushback. And our podcast friend, Rebecca Rocky, she's at Cushman Wakefield. We had her on as a guest, I think, last summer. She had a great quote, saying that this the rising cost of data center pushback will probably trigger a geographic rebalancing as there's more opposition, as regulations intensify against data center development in more dense kind of established markets, like we've talked about Data Center Alley in Northern Virginia, that we're likely to see development kind of migrate to secondary and tertiary markets where maybe population density is lower and they can expect less community center pushback. So a lot of things happening on the AI front and technology front, and certainly a lot more scrutiny, which investors will need to take into account.
One of the Wall Street analysts had a great line, and I wish I could remember who said it. I'd read it in an article. They were calling, or he or she was calling, the data center investment the most overhyped or overpursued investment since the railroad. So we're talking about something, I guess railroad investment was probably like 1850s. We're talking about nearly 200 years since the last big thing like this. And I don't think railroad investment worked out all that well for a lot of people back then. I think a lot of people said, we're going to start a railroad, we're going to put some tracks on the ground. I think that not all people who did railroads ended up profiting. I think a lot of went out of business chasing the dream. Hopefully that is not the case with AI, but certainly in the AI case, the backers of these things have plenty of financial strength. And we're not talking about startups here when we're talking about Amazon and Google and Meta and others.
Mm-hmm.
Switching gears here, Dianne, you have been keeping your finger on the pulse of what is one of the bigger commercial real estate conferences that takes place every year. The CREFC Council has 2 every year, one in Miami and one in New York. The one in New York finished just yesterday. What are you hearing about it?
I have to say I did not attend, so I have been watching it from the sidelines, but I went to a terrace party that was hosted by Rockport, and it was scheduled around the CREFC conference, so a lot of attendees were there. I have to give a shout out to a young woman, Abby McPherson. She is a loyal listener to the podcast, Manus. I met her last fall in Austin at the Commercial Real Estate Women's Network convention because Abby won one of their scholarships. And so she's been listening to our pod since then. She just graduated from the University of Denver and she relocated to Manhattan. So she's ready to start her career in commercial real estate. And she attended CREFC to network like a boss. Side note, I love spending time with young professionals. It always gives me great hope for the future. She's way more ambitious and outgoing than I was at her age. But Abby just sent me a summary of the CREFC conference session. So 2 things I wanted to share from Abby's takeaways are that the market's early year optimism has cooled but not disappeared. Inflation concerns, tighter spreads, geopolitical uncertainty are back in the conversation, and they're shaping how lenders think about risk and pricing and refis. And the second is that still capital is available. The market is more selective, but it's not closed. And lenders are competing aggressively for the right opportunities. Spreads are tightening, and borrowers are looking for higher leverage solutions to close refi gaps and protect their equity. So thank you to Abby McPherson for that. And I think it's a nice segue, Manus, to our data dive, which is that our May CRE activity index is about to go live this afternoon. So I have the final numbers here to share, and I want to hear your feedback. The May index slipped only modestly in May to 126.6. That's down from April's 127.5. So I'd say that's a small dip in a month that had plenty of reasons for activity to pull back. It was the 5th consecutive month of triple-digit readings and the 2nd straight month above 125, which is a level that the index hadn't reached since May 2022. So what do you think, Manus?
Well, first of all, I think that the summary of CREFC was really spot on. Thank you for sharing that. Certainly well written, and I think it tethers very closely to the way you and I feel that the market is soldiering through.
Yeah.
It sounds like people at CREFC are seeing things the way you and I do. I have to say, I am incredibly encouraged by that May activity index number. Not super surprised that we're continuing to soldier through as an industry, but I would have expected a little bit more of a downturn, maybe 3 or 4 or 5 points. I wasn't expecting the rug to be pulled out from under us. I wasn't expecting a 105 number, but the fact that it was essentially unchanged month over month, now a full 3 months into the war in Iran and a full 3 months since oil has jumped by between 25 and 50%, is remarkably encouraging. And it just sets us up well right now. If we can ever get the war over, imagine what kind of activity we'll see in the second half.
That's true. And you just reminded me of something else I wanted to mention, which is that for any listeners who have been here before, you know that the index is rooted in 3 different measures of CRE momentum. There's environmental due diligence, there's lenders' demand for appraisals, and there's the volume of property listings that are coming onto the LightBox Live platform. And the performance in May relative to April was not even across those 3. So the environmental due diligence component went up 6% over April, while appraisal awards and property listings each went down by 3%. And that was pretty consistent in terms of the pattern of recent months too. Property listings are still strong. Due diligence is strong, and they're offsetting slightly softer appraisal demand. So I do think June will be very telling. You know, Manus, you and I have said before that if the war ends by mid-year, it would position CRE for a strong second half. But that's starting to feel less and less likely because we're almost mid-June now, and an agreement to end the conflict is still so elusive.
You're right, Dianne. This continues to just kind of endure in not a positive way, these geopolitical events, whether it's in Lebanon or Israel or Iran, even the Ukraine, it just continues to be the war that never ends. But I will finish this particular segment with one observation, and that is, now that we've seen 3 full months of data since the war began, you can no longer say that we're getting the benefit of things that were already in the pipeline before the war started. You might have made that argument in March that deals were too far along to pull the plug on, maybe even in early April. But by the time you're getting to May, you're talking about deals that were circled after the war began. And that's the most encouraging thing for me of all, that all these deals that closed last month closed, or the listings that were made or the appraisals that were ordered were done with full knowledge that oil was already above $90 a barrel. And that's very, very encouraging to me. And even though the appraisals dipped, I think that that's probably our best measure of economic forward-looking activity. A 3% downdrift in a period like this is a win for me.
Yeah, I agree. And I think the feedback from CREFC gives me hope that June's might at least sustain that level. You know, obviously barring anything unforeseen and dramatic, I expect the June number will probably stay kind of in the same ballpark. All right, let's do Did You Know? Because I know we have some deal headlines to cover too. So for Did You Know, we took kind of a fun turn here compared to what we typically cover. And we want to give listeners kind of a view into a day in the life at LightBox. So thanks to Kathleen Lavallee, who gave us this week's Did You Know? She looked at the average number of environmental due diligence orders, so the activities behind Phase 1 ESAs that are made on an average business day in LightBox's platform. So in 2025, it was an average of 662 environmental due diligence orders per business day. And year to date in May, that went up to 695 per business day. What do you think of that, Manus?
Well, kudos to our marketing team for coming up with the idea that we should start looking at metrics. I come up with the image, you've probably seen them over and over again over time, where they'll show an aerial vision of a city, time lapse, and you'll see all the cars moving and the lights going and all the activity that's taking place, maybe as cars go through Chicago or down the West Side Highway or the FDR in New York. They'll have that time lapse image, and you can just get a sense of how many cars are passing through these major arteries. And I would love to find a way to do the same thing with the LightBox piping. Over the next couple of weeks, we're going to do this day in the life type analysis, which how much is happening at LightBox on a given day on your average Tuesday during June. And you just said almost 700 environmental due diligence reports are ordered on an average day at LightBox flowing through our piping. We're going to try to produce similar numbers for our zoning reports, the sales transactions we follow, the appraisals that are ordered, all of the listings that are done through our RCM and Revere affiliates. And I think that if we could somehow come up with an AI view of this, which made it look like things running through a pipe in a city like traffic, I think people would be blown away at just how much information is going on our information highways day after day after day.
I love that. I love that visual. So stay tuned. We'll share more metrics in the coming weeks. But let's move, Manus, to some of the headlines on deals that caught your eye this week. Where do you want to start?
Well, I'm going to start with a somewhat unique one, something we've never talked about before. This is my weekly curveball that I throw to Dianne. For those that want to know the inside baseball, we kind of throw some notes together. We put them in a Word document. We do our best to capture some of the headlines, but most of this that you hear is organic. We're not sitting here reading a script and so forth, and something will run across my wire maybe 10 minutes before we start that just piques my interest, maybe for no other reason than it's different. And the one I saw today was a $1.2 billion sale in South Carolina, where it's expected that a rare earth mineral plant will be developed. You know, we've heard a lot about data centers, which we didn't hear much about 2 or 3 years ago. 5 years ago, it was all about life science centers. Before that, it was all about logistics centers. This is the first time I'm hearing a rare earth plant being developed somewhere, and I'm shocked by the price tag that was paid for this particular asset, $1.2 billion in South Carolina.
I did see that headline. I have to confess I didn't read the whole story, but $1.2 billion is a huge price tag. I never heard anything about rare earth metals and manufacturing, but it turns out the plant will produce permanent magnets and refined rare earth metals that are used in industries like defense, like aerospace, like semiconductors, and of course AI is there. So sounds like this is a pretty major manufacturing win for South Carolina.
Well, listeners know that I spend most of my year in South Carolina. This particular investment won't be too far from where I live. It's not right next door, but it's within probably 45 minutes or an hour. I have to say, South Carolina does a terrific job inviting companies in. It's a very friendly business climate, and I think that this underscores that. I think it's really important, too, because the administration, the Trump administration, has talked over and over again about how rare minerals short we are as a nation, that we need to invest in this particular asset. And this sounds like a great new development, 490 new jobs coming to Cherokee County in South Carolina.
It's not too shabby, Manus. You might be sitting in more traffic than you're used to if this trend continues.
Well, maybe I'll start mining my backyard. If these rare minerals are as rare and sought after in the backyard, you might see me with a hoe and one of those old, what do they call those things that the guys used in California where they would shake the thing, and a sifter. You might see me with a sifter in my backyard. I don't know if I could identify a rare mineral with the naked eye, but hey, look, if there's gold in my backyard, I'm going to at least take my shot.
Yeah, you could be sitting on a gold mine there and not even know it.
There we go.
All right, Manus, let's move over to industrial. What do you have on that front?
Well, we saw several big transactions this week, which underscores the point that we've made for many, many years, and that is that the industrial rally never seems to peter out, even though we hear about rental weaknesses or leveling off in places like the Inland Empire in Southern California or in South Florida. Nothing ever seems to throw cold water on this particular rally. And this was another week of nice headlines. The first one, BKM and Kane Anderson paying $1.8 billion for 8.5 million square feet for a light industrial portfolio. Again, you see things like this all the time. Big portfolios changing hands for high 9 digits, 10 digits, and this is just the latest example of that. Another one we saw this week, this was said to be the largest single property industrial sale in the Chicago market since 2021. Reporting here from Matt Preston of Commercial Search, Realty Income paid $124 million to acquire a 900,000 square foot warehouse in University Park, Illinois. That's about 35 miles south of Chicago. One last one, 2 Waukegan industrial properties sold for $47 million. John Schreiber's Centaur Capital bought the buildings from Venture One Real Estate. So again, an upper Midwest sale that caught our eye.
Those are great. And the Link Logistics one, $1.8 billion that went over to BKM Capital Partners and Kane Anderson is huge. And that portfolio, I think I read, was 90% leased. There's an investor writing a big check for industrial when the rent roll, when the location, when the tenant mix are compelling. And, as Blackstone's logistics platform, Link Logistics, they're recycling capital out of stabilized assets or non-core assets. And this is just the latest news in that strategy as they then use that capital and reposition into other opportunities. But $1.8 billion is a pretty high price tag for an industrial portfolio.
That's a perfect segue to another similar, let's call it adjacency in the industrial space. I'll take us to the office segment. This one caught my attention this week. It's because of an industrial player moving out of their comfort zone and moving into the office space. The headline here, LXP Industrial Trust, that REIT purchased the former University of Phoenix headquarters in Phoenix, of course, for $103 million. The interesting thing here, LXP, known as its name would suggest for investing in industrial spaces, moving outside of its comfort zone. Here, acquiring a former office campus. It was used by a private university. It paid $103 million, which is a 44% markdown from the $183 million that the property last traded for in 2015. The seller, in this case, Epic Apollo, the deal works out to about $164 a square foot. The problems there really come down to the tenant. University of Phoenix once was the sole tenant occupying the entire property. Now they've pared that space to just 80,000 square feet. leaving a big, big hole, and that contributed to the huge decline in value. Reporting there again, mentioning him twice in 1 week, Matt Preston of Commercial Search.
44% markdown is it's pretty significant. So yeah, that's part of the theme of many of our stories these days is the repricing that's happening in that space.
Well, there's probably people out there that might say, I would die for only a 44% discount. We've seen a lot of these distressed sellers have to sell their properties in Portland or Chicago or San Francisco for 70 or 80 or 90% off. So there might be some people out there that said, if I can get a 56% bid on my property, I would take it in a heartbeat. So dare we say 44% discount is the new flat?
Yeah, very true. Perspective matters, right?
So I do want to turn to one last story on the headlines. This one, it fits my basically standard of trying to pick out a story every week that just highlights votes of confidence and leaps of faith in the market that is so critical to commercial real estate. Behind every building you see in any city or in any suburb or in any small town across America, somebody looked at a vacant piece of land one day and said, that would be perfect for a CVS or a shopping mall or a 44-story tower or a mixed-use community. So it's part of the American fabric that there was somebody with a dollar and a dream that said, I'm going to develop something big and useful and profitable on this particular parcel of land. And we could probably write a book of 10,000 pages of the Aesop's fables stories of people that have made their way in the world in commercial real estate. And they would be so interesting and so worthy of telling. And that's who I am. I love these stories, and I love the people that are confident enough to take that next step. So I'll close with this in our stories. This one takes us back to Chicago. It's near the United Center, which is where the Bulls and the Blackhawks play, the NBA and the NHL teams. The Reinsdorf and the Wirtz families, two big sports owners' families, plan to break ground on a project known as the 1901. It is a $7 billion project where they hope to bring 9,500 apartments, plus hotels, entertainment, and more to Chicago's near west side. So maybe this will become the next Aesop's fable, although in this case, those families have already had their moment in the sun and have acquired great wealth. But again, they're taking a big risk here, and risk is part of the CRE equation.
Yeah, exactly. I love that story, especially because we were talking just a few weeks ago about the momentum that Chicago was seeing, or broader Midwest markets in particular. I know that was a topic that you covered on the Prop Moto multifamily webinar that you did as well. And by the way, I love the idea of you writing an Aesop's Fable type commercial real estate book. Maybe that's a good retirement project for you. Just don't retire anytime soon.
Love it. So it's time to pivot to our slice of life. Dianne, I will tee you up for this one. We started the podcast talking about the Knicks. My heart was probably racing at a level that is dangerous for a person my age last night, but it was a thrill, and it was a thrill to be able to watch it with my youngest son. It'll be something we never forget. I wanted to start with you and ask, what was your favorite all-time sports watching moment? It could be anything from a professional team to even maybe one of your children playing t-ball back in the day. You must have one memory that props up in your head all the time where you said, wow, that was a great day.
Well, I'm not going to go back too far because I love to watch horse racing. It started when I was going to school in Baltimore, and we would go to the big horse race around Memorial Day weekend in Baltimore. I love betting on the ponies, and I was like absolutely blown away this year by Golden Tempo winning the Kentucky Derby with 23-1 odds. It was the first time that a female trainer won, and if you haven't watched this race, you really should, because this horse was close to dead last and then just covered so much ground and took everybody by storm. The commentators weren't even talking about this horse. And then he did it again in the Belmont Stakes. And the odds weren't quite as high based on his previous winning, but it was just really, really phenomenal to watch. I loved it. How about you, Manus? I know you have a good story here.
For me, anytime I saw one of my kids do something successful, score their first goal in 7-year-old soccer or score their first hockey goal or make a hoop in basketball, right? None of us were going to the NBA. None of the Clancys were I'm never sure there has even been a Clancy in the NBA for that matter. So, it was always just appreciating the moment for what it was. So certainly at a personal level, that was it. At a professional level, probably 10 I could rattle off, but I'll go with one. There's a famous Ranger game at which the announcer at the end of the game screamed Matteau, 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 and the Rangers moved on to the Stanley Cup Finals in 1994. I was blessed to go to that game with a friend of mine, and I would say on that night when the game ended in double overtime in 1994 that my heart was probably going about 300 beats a minute.
That's funny. Somebody I know who was watching the Knicks game last night said that her husband almost stopped breathing just watching that final play. It took him an hour to recover.
He's probably not the only one. I think that there was a lot of guys reaching for their rescue inhalers.
Yeah.
At about 11:30 last night.
That was unbelievable. I think I've watched that final shot probably 10 times, just like when UConn got that three-pointer that got them into the Final Four of the NCAA this year. No matter how many times you watch it, you can't believe it.
It was just great basketball.
Yeah, for sure. All right. Well, thank you to our producers at Bruning Media. Be sure to join us each week as we break down CRE news and data in context. You can listen on all your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great weekend.
Let's go.